Hello and welcome to this latest market update with me, Andrew Dawkins from A.R.D. Consultancy. So September has been an unusual month for many because it's the first time in a long while where we've actually seen negative returns from just about all sectors that we invest in. We've not seen this for quite a few months now, so it's one of those things that generally we take in our stride because there are times when investments will fall in value and other times when they rise. But this month in particular has been hit by a few things. So the US government considering pulling back on its quantitative easing, the publishing of money to buy back other debt, and that looks like it's going to be eased in the next month or two, and that caused the market a little bit of worry to see what happens to the economy after the stabilizers come off, so to speak. The same thing, the Bank of England here in the UK, with inflation perhaps being an issue here, with the coming up to numbers that really we don't want to see in terms of inflation, and that's mirrored throughout Europe as well. Inflation starting to gain hold as well, really there's a shortage of many things throughout the world, and this is leading to prices climbing higher, most notably in energy. And that's probably the biggest shock to the world, with the supply and demand for energy far exceeding what's being made available currently. And with winter ahead, it's like it could be a bit of a rocky road for anybody that relies to a large extent on its production from the likes of oil and gas. We've also got the shortage of people, and people in key positions such as lorry drivers here in the UK, but it's not only in the UK, in Ireland and in many places in Europe there's a general shortage of drivers. So anybody wanting to retrain, it is probably the career for the next 5 or 10 years. Also, hospitality has been hit by a number of people leaving the sector and saying, well, why should we put up with low wages and dreadful working conditions by and large, and they've found other positions to suit them better over the course of the pandemic. In the UK as well, we've got the ending now of the government support scheme for salaries, and this could lead to increased unemployment. However, there's over 1 million positions to be filled in the UK, so people are saying that there are jobs there. Depending on whether people want to do them or not is another thing. Government debt is again one of those areas that is not making huge returns in terms of the safer style of investments, so we're keeping an eye on that, but just at the moment equities look like they're the better long-term performer. So overall we've seen throughout the world, so that's North America, Europe, the UK and the Far East, have all delivered negative returns generally over the month of September. Property too is down in valuation terms. And as we say, no bad thing to see negative numbers, because that's where future profits are generated from. And we've all experienced the great returns that we've seen over the last year or so. So to look at the individual portfolios, and we'll get the performance this time over the last 1 month, 1 year, 5 years, and now 10 years. First of all, our defensive portfolio, so this has little if no equity exposure. So over the month it's down 1.73%, year to date up 5%, 5 years up 25%, and 10 years up 83%. Moving on to the cautious portfolio, over 1 month it's down 2.17%. 1 year we're up 9%, 5 years we're up 35%, and over 10 years 114%. Then our balanced portfolio, roughly about 60% equity holding here. Over the last 1 month down 2.52%, over the year positive 14%, 5 years up 50%, and 10 years up 155%. Our capital growth portfolio, roughly 80% equity holding. Over the month down 2.81%, over the year up 19%, over 5 years up 65%, and over 10 years up 210%. And finally, the aggressive portfolio, above 90% equity holding here, and over the last 1 month down 3.02%, over 1 year up 24%, 5 years up 81%, and a staggering 10-year return of 284%.